Listen up. Welcome to today's Explainer. I'm Steve, and right now, you and I are stepping directly into the eye of a massive macro hurricane. The Federal Reserve just dropped its 2 p.m. interest rate decision, and man, the financial landscape is undergoing a massive structural repricing. You know, the mainstream talking heads are already out there screaming that a full-scale bear market is imminent. But look, we are going to break down exactly what happened, why it happened, and how you need to position yourself moving forward.
And that brings us to the core philosophy of this desk. We don't trade emotions, we track the hard numbers, period. When the market flushes, panic is for amateurs. As veteran traders, our job is to completely ignore the noise and focus purely on mechanical capital flows and the active moving averages. Today, we're opening the ledger on exactly how smart money handled this post-Fed liquidation.
All right, Section 1, the post-Fed market flush. I really want you to see the immediate tape damage here because the bears pressed a massive programmatic advantage this afternoon. This wasn't some slow, casual bleed. It was a systematic, brutal sell-off. The S&P 500 absorbed a really heavy blow, flushing 1.21% to lock in a firm closing print at 7,420.10. Spot gold took a sharp hit too, sliding almost a full percent to settle right near $4,324 after hitting a literal brick wall at crucial resistance. And over in digital assets, Bitcoin experienced a steep, leverage-fueled cascade, dumping 2.22% to settle near $64,162. The entire board just lit up red.
Section 2. Unpacking the hawkish catalyst. Let's look behind the curtain. So what exactly triggered this broad market flush? Well, let's define the actual weapon that caused the damage today. The central bank held interest rates steady at 3.75%, which was exactly what we expected. But they delivered a highly restrictive, incredibly hawkish twist to their dot plot, the summary of economic projections. They signaled that borrowing costs are going to remain locked in higher territory much deeper into the year. In an absolute flash, that aggressive projection wiped out the multiple rate cuts that systematic funds had been comfortably modeling for the second half.
The crucial point you have to understand here is the chain reaction. Automated sell programs were triggered instantly. Look, nobody on a professional trading desk wants to carry highly leveraged growth positions into an extended period of high borrowing costs. It's just bad business. So the algorithm systematically sold across the entire equity curve, ruthlessly flushing out all those late emotional buyers who chased Monday's peace deal rally. The machines took over, folks, and they sold the news hard.
Moving to Section 3, tech valuations hit the ceiling.
We have to focus on the specific casualties of the day because the mechanical selling targeted our core growth engines, the megacap tech and semiconductors. These groups have practically carried the index all quarter, making them the ultimate source of liquid capital when funds suddenly need to raise cash. As fixed income desks reacted to that sticky, hawkish Fed tone, they pushed long-end Treasury yields straight up. And when the cost of capital rises, automated models are forced to brutally contract the price-to-earnings multiples on these high-flying tech stocks. It's a classic central bank playbook. A restrictive macro environment means valuation ceilings come crashing down fast.
Section 4. The energy curve release valve. Now, it's not all doom and gloom. Actually, scratch that. There is a critical structural divergence happening right now that is literally keeping this market from a total uncontrolled meltdown. You have the severe headwind of a hawkish rate policy battering tech, sure, but on the flip side, a massive energy tailwind. The formalization of the U.S.-Iran de-escalation framework and the physical clearance of the shipping backlog in the Strait of Hormuz are acting as a vital economic cushion. Plus, the massive SpaceX IPO has finally completed, thankfully stopping the drain of liquid capital out of the broader risk markets. These factors combined are providing the exact defense the market desperately needs today.
Let's really hammer home the staggering magnitude of this energy tailwind. Negative 4.77%. That is the massive collapse we just witnessed in Brent crude. In the physical pits, crude oil went into a state of absolute freefall because market participants are rapidly pricing in that full reopening of the Strait of Hormuz.
And that brings us to the exact settlement price, 83.16, for the active July paper contract. Now, why does this matter to you if you strictly trade equities? Because this collapse in the energy premium acts as an immediate, massive corporate tax cut across the entire S&P 500. Lower input costs and cooling logistics pressures mean that corporate profit margins instantly expand. That fundamental cushion is exactly what is protecting the S&P from a full-scale structural breakdown right now.
Section 5. Tactical blueprint and levels. Let's get to the action plan. The cards are officially on the table. So how do we manage our risk and execute like professionals? Step 1. Acknowledge the technical damage. The post-Fed drop completely wiped out our short-term 20-day simple moving average. It's just gone. That failure is now forcing a direct, high-volume test of our core intermediate anchor.
So, here are your absolute rules of engagement moving forward. First, watch the upward-sloping 50-day exponential moving average. This is your absolute line in the sand. If the index breaks and finishes below the 50 EMA on a weekly closing basis, the intermediate primary bull market is officially compromised. Second, cut your position sizing in half immediately to protect your capital. And third, sit on your hands. Let this initial programmatic volatility clear out before putting fresh size to work. Protect the downside first.
That's the reality of the tape, plain and simple. We've mapped the macro hurricane, we've found the energy cushion, and we've drawn our lines in the sand. Remember, the ledger is open and the levels never lie. You must trade the reality on your screens, not the hope in your head. So review your charts, manage your sizing, and ask yourself, are you ready for the morning bell?